Welcome back to Closing Bell Extra Time on the 11th of November 2020, and on the Extra Time I will be focusing on the UK stock market. I put up my hand. I've neglected all my UK viewers because I focus on the US stocks. Because my fear of Brexit and the falling declining in GBP, I've just endlessly been pumping money in the US market and Chinese market, but not the UK market. But when I look after this 3 days of recovery, I think there's sign of hope, and I want to just narrow down to 3 groups of shares on my views, and please do your homework and please share your comment below if you agree or disagree as well. The first one is Experian. Okay, Experian, it's still about 10% growth. 10% is not a lot in the US, but it's a lot in the UK. So Experian is one of those that institutional fund manager will keep buying for slow growth, for steady, stable growth. Okay, so basically Experian, like you and I know, they check your credit rating score, and they have been doing this for many years. Think about it. When these companies collect information from you, they have got vast amount of data, honest data, and they can use this data to create new financial tools, and they'll be working collaboratively with countries around the world, banks or fintechs. So Experian is something quite stable, quite core, and will last a very long time. So that's Experian. That's my first one. And the second one is Flutter Entertainment, basically the ex-Betfair, the ex-Paddy Power, until the Canadian and came over and bought them up. Canadian company called Star Group, also gambling company who's responsible for lots of poker game online apps. So P ratio about 144, it's high, but they still get the 10% growth year on year. COVID-19 never affected them. Think about it, in the whole world, besides Las Vegas casino type stocks, UK has got the most best online gambling, video gambling type stocks. Look, they're only 20 billion. I know they look like they're 134 pounds, like crazy. Who's going to invest in them? Think about it. DraftKings is 15 billion, and DraftKings not making money. What does DraftKings do? They still barely, not much products to shelf on a platform. But Flutter Entertainment is 20 billion. And because they've got access to the Canadian counterpart, with US opening up to more gambling states, you see where I'm coming from. So Flutter Entertainment, if you high risk, high play, high roller, I wouldn't mind buying some Flutter Entertainment. And the next one, I always liked this company, but I never bought them. LSE, London Stock Exchange. We know that London is the hub of financial in Europe. Maybe not after Brexit, but LSE is still a place where many companies wants to go and IPO. You got lots of Australian companies, mining companies. You got lots of Asian companies wants to come and IPO in London Stock Exchange. So they've been going up in a straight line. Every time they dip, I never had a chance to buy them. If they dip, they don't dip that much. So they're pretty defensive. They pay very low dividend because growth stocks keep climbing. But I cannot see how London Stock Exchange will stop, because you just get bigger. After Brexit, I think it will benefit London Stock Exchange with all the individual trade deals with US, Australia, Malaysia, Thailand. They go do all the trade deals. I think London Stock Exchange will benefit very much. Okay, next, let's go to the recovery group. Recovery meaning they're injured just now, but if they do recover, they will grow back up, and also they possibly might pay you dividend first before any other stocks. The first one is my all favorite pie shop, Greggs. I miss my Greggs, and I'm sure when Greggs open up, students will be flocking. It's one of those, it's better than a Subway. Greggs is like the English McDonald's. We go to McDonald's for breakfast, but we go to Greggs for lunch. So Greggs have got P ratio 431. It's so high, but because they're still making money, they're not making loss. They're still making money, still in profit. They're not at loss yet, but they're recovering. If country starts opening up, Greggs will be the first one to benefit. And I think there's like 16 pounds just now, and they should have an upside at 20. Will they reach up there? Maybe slowly, but return to growth in favor, and then after dividend payout later, and then it starts slowing down. Greggs would be a good hold, because anything that we eat that we like from Greggs, they will never go away. Okay, next one is Barclays. Barclays will be the only one of 2 banks that I'll buy when interest rates goes up. If you think that Barclays is something that you believe in, you buy. Why? Barclays has got exposure in the US. Barclays is also an investment firm, and it showed that during COVID-19 they've not made much in retail or mortgages, but they've been doing really well in the investment counterpart. So Barclays PE 12 may return dividends next year, but be aware it's going to be slow, but it might be growth first and dividend. It's not going to go back to its normal growth, but it takes time. But I think the investment counterpart, if they focus on it, they might do well. Okay, the last two stocks, please research. High risk but high reward at the same time. Okay, don't think that it's guaranteed going up. I might be wrong here. Okay, I've already gone in. I think people have read my comments. I've gone into this oil company. It's Premier Oil. Premier Oil, I went in about 14, 15, and now it's jumped to 16, 17. Premier Oil has just done a SPAC, SPAC, reverse merger with a company called Chryso. I know it well because I am here. The company is not far away from me, around the corner from me. So I know people working there. So this is not inside information, but I'm just telling straight up. Premier Oil will be reverse merging. They might lose their PMO title. They might go with someone else. But Premier Oil is merging and will become the biggest oil company in the North Sea, biggest oil producer. They might be bigger than Shell and BP and Total in the North Sea. Once this merger gets together and the debt being reduced. They're sitting about 16. I think the potential going up to 50p by 2021 at some point. If oil starts hitting 50, 55, they must hit 50p. Yes, I'm telling you, there's a potential of threefold there. But at high risk again. Okay, so that's Premier Oil. I'm going to stop there. Last one will be Aston Martin. Aston Martin 50, 60p. It's cheap. Okay, luxury stock. Okay, reputation are not built by the day. Reputation are built over decades, over multiple James Bond movie. Aston Martin is losing money just now because whatever they're producing goes to showroom and not gets sold. It comes to a point where Aston Martin starts making good quality SUV, and that's coming out of the first electric vehicle. They want to make everybody excited about their brand again. And being bought out 20% by Mercedes, that might help with a bit of boost and a bit of guidance from the German counterpart. So, they're not going to grow tomorrow, but potentially in the next 2 years, 3 years, Aston Martin will not stay at 50p, 60p. They should be a £5 company. Okay, £5 company if once they produce cars from the factory and straight delivered to the person's home. Nothing held in your showroom. That's how Ferrari sells their car, and that's how Aston Martin should sell their car. Please do your own research. I'm not going to give buy, trigger, point, pie because they're all really weak anyway. I mean, how low can they go? This is not a show-win situation, but you need to work out your risk and your reward. This is me. I've spoken too much. Please click like and subscribe. I want to hear you if you think I missed anything, but I think it's over for me tonight. I better get back to bed.